Kraken launches CFTC-Regulated Perpetual Futures for U.S. traders. Kraken switched on CFTC-regulated perpetual futures for U.S. customers on June 15, 2026, according to a report from CoinDesk, citing the exchange's own announcement. The contracts run through Kraken Pro and Clear via Bitnomial, a CFTC-regulated futures exchange that Kraken's parent company Payward acquired in 2026. For U.S. retail traders, this is the part that matters. Perpetual futures have been an offshore product for most of their existence, and now a major U.S. exchange is offering them under domestic commodities oversight. Perpetuals are the dominant instrument in crypto trading. They behave like futures but never expire, using a funding rate mechanism to keep the contract price tethered to spot. Until now, U.S.-based traders who wanted them mostly had to use offshore venues outside the reach of U.S. regulators, or settle for CME-listed dated futures that work differently. Kraken is collapsing that gap inside a single regulated interface. The size of the market Kraken is reaching for global perpetual futures volume topped $60 trillion in 2025, and the overwhelming majority of that flowed through offshore platforms. That figure is the real story here. It is not that perps are new. It is that a multi-trillion-dollar activity has been happening almost entirely beyond U.S. jurisdiction, and a domestically regulated path to it has been missing. Bringing even a slice of that volume onshore changes who can participate and under what rules. A CFTC-regulated product sits inside a known compliance and reporting framework, which is the precondition most U.S. institutions need before they touch an instrument. It also gives retail traders a venue that answers to a U.S. regulator rather than an offshore entity with opaque recourse. The Bitnomial route. The mechanism is the acquisition. Payward bought Bitnomial, an exchange already designated to list futures under CFTC rules, and is using that designation to offer perpetuals to U.S. users through Kraken Pro. Rather than wait years for a bespoke approval, Kraken folded an existing regulated venue into its stack and built the product on top of it. That integration is the selling point Kraken is leaning on. The company is putting spot trading, margin, CME-listed crypto futures, and the new perpetuals in one interface. So a trader can move between cash and leverage positions without leaving the platform. Long and short positioning is available from day one. Initial coverage spans Bitcoin, Ethereum, Solana, XRP, Cardano, Chainlink, Dogecoin, Litecoin, and Avalanche, with more contracts planned. A crowded onshore race, Kraken's head of derivatives, John Palmer, said adoption may mirror the trajectory of spot Bitcoin ETFs, with sophisticated traders entering first and investment advisors following later. The comparison is a deliberate one. Spot Bitcoin ETFs took a regulated wrapper around an asset people were already trading offshore or awkwardly, and the regulated version pulled in capital that the unregulated one never could. Kraken is not alone in this lane. Kalshi launched perpetuals earlier in June and cleared more than $1 billion in volume within a week. Hyperliquid has built a large offshore-style perps market with on-chain settlement, and Coinbase has been pushing into U.S. derivatives as well, including its recent move to run 24/7 gold and silver futures for U.S. traders. The competitive picture is a scramble to be the regulated home for an instrument that, until recently, had no regulated U.S. home at all. For everyday crypto users, the immediate takeaway is narrower than the headline. Perpetual futures are leveraged instruments, and leverage cuts both ways. Funding payments and liquidation risk make them unsuitable for anyone treating crypto as a spending balance rather than a trading position. If you hold assets to spend from a crypto card rather than to trade, this launch does not change your day. What it changes is the regulatory map. A category of activity that lived offshore now has a CFTC-supervised U.S. entrance, and that tends to be the start of broader institutional participation, not the end of it.